Good morning, folks. Welcome to another episode of the Daily Read with Jeff Kikel here on Exit Rich, Retire Free. So today is a very interesting day. We're getting close to the end of the week and we've got major earnings coming in. We've got geopolitical issues. So let's get started and talk a little bit about what is going on in the world today. Today, the market was busy panicking over a dramatic geopolitical headline, but the message that actually mattered came from a much more boring place, Walmart. The store was basically the store where basically everybody shops, just quietly told us something important about the American consumer, and it wasn't great. So let me explain here. Regime Lab today is a mix of loud noise and a quiet, important signal. The loud part, another geopolitical threat sent oil spiking toward $88 and rattled stocks. This was the president talking about the economic D-Day for Iran, where we're going to be placing even stricter embargoes on Iran at this point. So that panicked everybody, of course. But the quieter, more important part is Walmart's earnings. Here's the thing. Walmart actually beat on profits, but its US store sales came in softer than expected, and the stock dropped 6%. Why does this matter so much? Because Walmart is where America shops. It's the single best read that we have on the health of the everyday consumer. And today, that read flashed yellow. So here's why that Walmart number is such a big deal. The American consumer is the engine of this economy. Consumer spending is about 70% of it. So when the biggest, most everyday retailer, in the country says its US sales are growing slower than expected, that's not really about one company. It's a window into whether regular families are starting to pull back. And here's the fascinating twist. It landed in the same week that factory data came in red hot. A key manufacturing index blew right past expectations. So we've got a genuinely split screen economy right now. The industrial side is humming, but the consumer side is starting to tire. And those two usually don't pull in opposite directions for too long. Eventually, one of them has got to give. So what does this mean for you? Mainly from here, pay attention to the consumer story because it's the one that decides where all of this goes. A tiring consumer by itself is not a crisis. Walmart still grew, just less than hoped, and other retailers like Target actually sounded upbeat. But it's the first real crack in the everything's fine story, and it lands at the worst possible time, with interest rates high and oil climbing, both of which squeeze household budgets even more. There's two tells to watch here. First, as Walmart's warnings spread, if the next round of retailers and the spending data start echoing the consumer is slowing, that's a real trend, not a one-off. And a second watch is oil. It jumped again towards $88 today on a fresh Middle Eastern threat. And higher gas prices are a direct tax on the exact consumer that's already tiring. If oil continues climbing, it pours fuel onto the fire, one fire that matters. So just in summary, today's market thesis was the Walmart's warning. Once again, market confidence is still a medium. We are still moving up. We are seeing a rotation in the market away from some of the AI stocks and moving into oil and industrials and financials, healthcare, areas like that. So we are seeing a broadening. Now, does this consumer slowdown spread? And if does oil continue to go up? So we're in really a split screen economy right now, strong factories and tiring consumers. Watch the consumer because that's the one that is the majority of our world here in this country, especially. That's your daily read. I'm Jeff Kikel with Exit Rich Retire Free. As always, these are for educational purposes and not investment advice. But if you'd like to take or talk through your own plan, you know where to find me. So thanks a lot, and we will see you guys back here the very next time.